With the market closed for the day, Opendoor Technologies Inc. (OPEN) finished the session at a closing price of $6.04. This marks a notable decrease of 1.06% from its opening price today, a figure that on the surface might seem like a minor pullback, but the story behind this particular day's trading is far more complex. The intraday movement saw significant volatility, with the stock initially opening higher, hitting a day's high of $6.43 before a sharp reversal pulled it back down to a low of $6.03. This kind of whipsaw action is a classic hallmark of a stock under intense pressure from both sides of the trade, a tug-of-war between a recent speculative surge and the hard reality of fundamental data. This isn't just a simple dip. It's a profound moment of reckoning for investors who have piled into the stock on the back of a narrative that may be getting ahead of the company's operational reality. The prevailing market expectation for Opendoor has been one of a phoenix rising from the ashes. For much of the last year, the stock was trading in the low single digits, hovering just above its 52-week low of $0.5084. The narrative of a turnaround, driven by a pivot in strategy and a housing market that, while challenging, still has pockets of resilience, fueled a massive rally. In the last month alone, the stock had rocketed over 171%, a move that captured the attention of every retail investor, from those using online investment tools like a Robinhood app to those looking for investment help on more traditional platforms. This was the expectation, that Opendoor had found its footing and was ready to capitalize on a shifting real estate landscape, shedding its past struggles. The reality, however, as evidenced by this recent intraday volatility and the cautious whispers from Wall Street, is far more sobering. The company's recent earnings report, while showing a beat on revenue, came with a grim outlook. Management's guidance for the third quarter was alarmingly weak, projecting a significant year-over-year revenue decline and continued margin pressure. This created a stark contrast to the speculative fervor. The stock's recent run-up has appeared to have been driven more by a speculative frenzy and a short squeeze dynamic, rather than a genuine re-rating based on improving fundamentals. The disconnect between the stock price and the underlying business model's profitability remains the central tension, a critical detail that self-investing enthusiasts might be missing. The recent trading volume has been staggering, with today's figures exceeding 100 million shares. This is not the activity of long-term conviction investors. It is the chaotic pulse of day traders and algorithms playing a high-stakes game. The narrative is often about the new leadership and strategic pivot, a shift from a pure iBuyer model to a more hybrid, agent-friendly platform with offerings like Cash Plus. The hope is that this new approach will be less capital-intensive and more resilient in a challenging market. However, the operational reality of this transition is slow and fraught with execution risk. The company is still saddled with an inventory of older, lower-margin homes, a direct hangover from its previous strategy. This older inventory continues to drag down profitability and contribution margins, a key metric for a business of this nature. The market is grappling with this duality, the promise of a new, more durable business model versus the painful legacy of the old one. This is a classic case of future expectation clashing with present reality. It is a critical lesson for anyone engaged in online investing, whether through an individual brokerage like Interactive Brokers trading platform or a managed one like Schwab Intelligent Portfolios. To understand the full scope of this story, we must look at the company's business model. Opendoor, at its core, is an iBuyer, a company that uses technology and data science to make instant cash offers for homes, then quickly resells them for a profit. The model is built on speed, efficiency, and a deep understanding of local real estate markets. It was a revolutionary idea, but it's also highly susceptible to market fluctuations. When interest rates were low and the housing market was red hot, the model worked beautifully. Opendoor could acquire homes, make minimal repairs, and flip them quickly, generating a steady, albeit low, profit per transaction. The problem is that this model is like a high-octane race car. It's thrilling when the track is smooth, but a single unexpected turn can send it into a wall. When interest rates began to rise and homebuyer demand softened, Opendoor found itself holding a substantial inventory of depreciating assets. This is where the company incurred massive losses and where the stock's valuation plummeted. Now, with the pivot to a more agent-centric model, the company's trying to de-risk its balance sheet and create a more predictable revenue stream. But the question remains, can they do it fast enough to satisfy a market that demands immediate results? This transition is a key point of risk, and it's why even with a stock that has seen such explosive growth, analysts have maintained a hold rating, with many price targets sitting far below the current trading level. This is where the expectation versus reality dynamic becomes most poignant. The excitement of the rally is a powerful emotion, but the cold, hard numbers on the balance sheet and in the guidance reports tell a different, more cautious story. It's a compelling case for doing your own due diligence and not just relying on the chatter you might find on investing sites or in social media communities. The future outlook for Opendoor is a study in conflicting signals. On one hand, the strategic shift is a smart move. By reducing its reliance on a volatile, capital-intensive iBuying model, the company could become more durable. Partnering with agents and providing ancillary services creates new revenue streams that are less exposed to the whims of the housing market. However, the macroeconomic backdrop remains incredibly challenging. High mortgage rates are a persistent headwind, depressing transaction volumes and making it harder for Opendoor to move its inventory. The company has a long road to profitability, with analysts projecting continued cash burn through at least 2027. This is a company in the midst of a dramatic, high-wire act of a business transformation, all while the ground beneath it is shifting. The opportunity lies in their ability to successfully execute this pivot and capture market share with their new offerings. The risk, however, is that the housing market remains subdued for longer than anticipated, or that competitors, including established players like Fidelity Investments, or even new fintech entrants like SoFi Invest, move into the digital real estate space with more robust, capital-efficient models. The story of Opendoor isn't just about real estate. It's a microcosm of the challenges faced by many tech companies that scaled too quickly in a zero-interest rate environment and are now trying to find a sustainable business model in a more restrictive one. It is a stock that requires a level of patience and risk tolerance that is not for every investor. The wild swings, the constant battle between hope and fundamentals, make it a fascinating but perilous ride. Now, I want to hear from you. Comment below how many shares of Opendoor Technologies Inc. you currently hold and what you think its price will be in 1 year. Is the recent rally a sign of a true turnaround or just a temporary bubble? In summary, the narrative surrounding Opendoor Technologies Inc. is one of a spectacular comeback story, fueled by a massive rally and the promise of a strategic pivot. The reality, however, is a company still grappling with a difficult macroeconomic environment, an unfavorable inventory mix, and a long road to sustainable profitability. The stock's recent price action, marked by extreme volatility and a significant daily decline despite an earlier surge, highlights this tension. The expectation of a quick turnaround clashes with the reality of slow, difficult execution in a hostile market. This is a powerful reminder that while online investing and access to real-time data through platforms like the Fidelity mobile app or SoFi Invest make trading easier, they do not replace the need for deep, fundamental analysis. The market may be captivated by the story, but it is the company's ability to navigate these operational headwinds and deliver on its new strategy that will ultimately determine its long-term fate.